I ended the last video going over brief exercise 1214 and had to kind of rush because the 15 minutes I have for these videos was ending. So let me go over this one more time just to make sure you get it. We'll start by reading it. Kim Company bought 30% of the shares of Phelps Inc. at the start of 2021. Kim paid $10 million for the shares. 30% of the book value of Phelps' net assets is $8 million. And the difference of $2 million is due to land that Phelps owns that was appraised, that has appreciated in value. During 2021, Phelps reported net income of $1 million and paid a cash dividend of $500,000. At what amount does Kim carry the Phelps investment on its balance sheet as of December 31, 2021? Now the first question to ask is this difference between the price that Kim paid and 30% of the book value of their net assets of $8 million, that $2 million difference, what is it associated with? If it were associated with depreciable assets, then we would have to record additional depreciation, reducing our share of their net income. Their net income was $1 million, so our share is 30% or $300,000. But that $1 million would be decreased by additional depreciation. If it were inventory, then that $1 million would be decreased by the $2 million because we would assume that inventory was sold and cost of goods sold should have been $2 million more. So that would have had a $1 million loss instead of a $1 million gain. Fortunately, the increase in value of the assets was attributed to land, which is not depreciable. So we don't have to worry about additional depreciation there. So we would carry the investment at the $10 million cost plus our 30% share of the $1 million. So that's plus $300,000. And then minus our 30% share of the $500,000 dividend. So 30% of $500,000 would be $150,000. So we have $10 million investment plus $300,000 of net income minus $150,000 of dividends. So that's where we get the fair value right here of $10,150,000 or $10.15 million. $10 million plus 30% of $1 million minus 30% of $500,000. Okay, I hope that explains that well and clears up any confusion I may have left. So let's go back to the textbook and we will pick up from there. So when you're using the equity method, fair value of the investment shares at the end of the reporting period is not reported. We're not concerned with fair value under the equity method. We're accounting for the company as based on our cost plus our share of their net income minus our share of net losses and minus our share of any dividends paid. Now they make the point down here, the equity method is sometimes referred to as a one-line consolidation. In a consolidation, we add the two companies together. Here we're doing that kind of in one line by valuing the company based on what we paid for our shares and then plus our share of undistributed net income since that time. So, or our share of any increase in retained earnings or decrease in minus any decrease in retained earnings. So that's where that term one-line consolidation comes in. They make the point here, if the investment's acquired sometime during the year other than at the beginning or end of the year, then we recognize the proportional share of net income that was earned after we bought the investment and recognize our proportional share of any dividends paid after we acquired our stock. Okay. When the investee reports a net loss, we report our share of that net loss as a net loss to our investment, and a net loss on reduction of our investment, and a net loss on the income statement. What if conditions change and we either switch from or to the equity method? Basically, if we switch from another method to from the equity method to another method, then we just report net income and dividends up to the point where we make the switch, and then we switch to the new method. So if it's to net income through a fair value through net income, then we would just switch to that, and any difference would be reported in net income as gain or loss, unrealized gain or loss. Change from another method to the equity method. Again, we just take whatever the value the other method had as our investment and then apply the equity method going forward. If an equity method investment is sold, then we just account for the sale as we would any other sale. So there you see a comparison side by side of value through net income and the equity method. I think we've covered all of the ground, so I don't see that I need to go over these entries or anything again. There they explain all of those steps. Now, this becomes important down here, the fair value option. As I said on one of the earlier videos, US GAAP does allow using the fair value through net income option instead of the equity method for investments where you have significant influence. The reason the equity method was adopted to begin with was to try to minimize the ability to manipulate income. If you're in a position to have significant influence, you can influence when dividends are paid. So a company that had an equity method investment, if they weren't accounting for it on the equity method and they needed additional net income, if they were accounting for it just at cost, then they could get net income by convincing the other company that they have an investment in to pay a dividend, and they would report dividend as revenue. So the equity method eliminates that because dividends don't affect net income for the investing company. Now, the fair value option also eliminates that because our main concern, we do report dividends as revenue, but at the end of the year, we recognize the fair value. So if the dividend reduces fair value, then we would show a reduction, a loss potentially, in the fair value in net income through fair value into net income. And so that kind of eliminates a problem. So as we looked at before, company makes a one-time irrevocable decision whether to elect the fair value option or whether to use the equity method. So it's a one-time decision when you acquire enough share to have significant influence, and it's irrevocable for that investment. Okay, let's look at the next homework problem. So brief exercise 1216. And there we have it. So Turner Company purchased 40% of the outstanding stock of ICA Company for $10 million on January 2nd, 2021. Turner elects the fair value option to account for the investment. During 2021, ICA reports $750,000 of net income, and on December 30th shows a dividend of $500,000, or pays a dividend of $500,000. On December 31st, 2021, the fair value of Turner's investment has increased to $11.5 million. What journal entries would Turner make to account for this investment during 2021, assuming Turner will account for the investment using the fair value through net income approach? Okay, so the purchase of the stock, you're just going to debit the investment, credit cash. ICA's reported net income, and using the fair value option, we do nothing with that. Turner does nothing with ICA's net income. Receipt of the dividend, debit cash, credit dividend revenue, and then the fair value increase. So our $10 million investment has gone up by $1.5 million. So what do we do with that? Well, we debit the fair value. Let's see, here it is. Debit the fair value adjustment and credit gain on investment unrealized through net income. So there's our initial investment. Debit the investment, credit cash for $10 million. Our recording of the dividend. So the dividend was $500,000. We have 40%, so that's $200,000 debit cash, credit investment revenue, and then recognizing the change in fair value, debit the fair value adjustment, and credit gain on investment. And again, that's an unrealized gain that gets reported as part of net income. Okay, and there they get into a different approach where you could use the equity method but then make adjustments. Don't bother reading that. That may just confuse you. So let's go back to the textbook and have about a minute and a half left. So right here, again, the equity method. Under IFRS, they do not allow the fair value option. Also, under International Financial Reporting Standards, there's a requirement when you're using the equity method to adjust net income for any significant differences in accounting policy between the investor and the investee. So those are really the only differences of any significance. Then we get to another one of those concept review exercises. And again, I want to encourage you to spend a lot of time going through those, making sure you understand exactly what's going on, why you do what you do, and knowing exactly what to do, how to do it. And if you memorize these, then that does you no good. You want to make sure you know exactly what to do and what the reason for that is so you can replicate it if you need to on the exam. Okay, I'm going to end the video now and we'll finish the chapter with the next video.